Thank you, everyone, for joining us for the webinar today. And I'm pleased to announce we have David Leibovitz doing the second part of the webinar. And David is the global market strategist for the Global Markets Insight Strategy team at JP Morgan Asset Management. And in this role, he's responsible for delivering timely market and economic insights to clients across the country. Since joining the team, he's helped build the Market Insights program in the UK and Europe, and has appeared on both Bloomberg TV and CNBC, and is often quoted in the financial press. David joined JP Morgan Asset Management in 2010, and prior to joining the firm, he was a research analyst at Cobrin Insight Management. And at Cobrin, he was responsible for small and mid-cap equity research. And David obtained a BA in political science and philosophy with a concentration in leadership studies from Williams College in 2009. He earned a dual MBA degree from Columbia University and London Business School in 2015. And with that, David, I'd like to turn the webinar over to you. Thank you again for agreeing to do the webinar.
All right, great. Thanks, Jeff, and good afternoon, everybody. While I pull my slides up, I actually think you need to make my other screen a presenter. I'm not able to do it from the box that is not showing my face. But while we get that all sorted out here, I will get my slides up in just a moment. Thank you all for joining us this afternoon. In terms of what I plan to cover during our conversation today, I want to start by talking a little bit about what we're seeing in terms of the global economy, our expectations for inflation going forward, and a little bit about how we're thinking through the various trajectories of policy that we've been incorporating in our macroeconomic forecasts. At that point, I want to switch gears. I want to talk a little bit about some of the challenges and some of the opportunities that we see across the capital markets, thinking about US equities, international equities, as well as fixed income. And then finally, I want to wrap up with a few thoughts around the outlook for volatility, the importance of long-term investing, and furthermore, the importance of staying balanced within the context of one's portfolio. So if we dive right in here and just take stock of where things stand with respect to the pandemic itself, it does feel like, at least in the United States, as well as in other parts of the developed world, things are slowly but surely returning to normal. What we're looking at here on this chart is the share of a country's population that has received at least one vaccine dose for COVID-19. And you can see that while places like China and Germany and France have caught up over these past couple of weeks, the US has been a bit of an example alongside the United Kingdom for effective rollout plans and effective vaccination. Now, I know there are some challenges to getting that herd immunity achieved, and we are sitting a bit below, and you have seen things in the United States plateau a bit relative to the pace of vaccination that was seen earlier on this year. But we very much believe that over the course of the next couple of weeks and months, we will gradually get to that key level of herd immunity, which we estimate is somewhere around 70% of a country's population. And really by the fall, we believe that the economy will be reopened and back to business. Now, in terms of what that means for the economic growth outlook, you can see that growth has already begun to rebound really quite nicely around the world. What we're looking at here is an economic indicator called the Purchasing Managers Index, or the PMI. And these PMIs, they're very contemporaneous economic indicators. They track the trajectory and the pace of economic growth quite nicely. And the way to understand these indicators is that 50 is the key level. So anytime you see a reading above 50, it indicates expansion. Anytime you see a reading below 50, it indicates contraction. But for the purposes of this chart, we're showing things as a heat map where green means good and red means not so good. Now, as I noted, you can see over on the far right-hand side of this chart that green shoots have begun to emerge across the global economy, and particularly across the developed markets. The United States has very much been leading the charge from an economic growth perspective over the course of 2021 thus far. But in places like Europe and in certain parts of the emerging world, we have certainly seen things improve here over the course of the past couple of months. Now, there are some soft spots. You look at places like Japan, You look at places like India and Brazil, they do have PMIs below 50. Obviously, the virus remains an issue in those parts of the world. It does feel like Japan is beginning to make some forward progress, and we do expect growth there to pick up over the next couple of months. As it pertains to the emerging world, things there are a little bit trickier. Most emerging markets don't have the healthcare infrastructure that we do in the developed world to effectively roll out vaccines. And that has meant that they are a bit behind places like the US and Europe in terms of getting their populations to that key level of herd immunity. But we very much view the recovery in the emerging world as being delayed rather than derailed. And we do think that as we move into the end of 2021 and the beginning of 2022, global growth will become increasingly synchronized and represent an environment not all that different from what we saw back in 2017. Now, I noted that the US is leading the charge, and I want to spend a few minutes on exactly some of the reasons why. Obviously, the vaccine has been integral in reopening our economy, and you can see on this chart that looks at a series of high frequency indicators how strongly things have come back here over the course of the past couple of months. And what we've done on this chart is looked at things like mortgage applications, hotel occupancy, the number of people sitting down for dinner, the number of people passing through TSA checkpoints. And then to the right of that dotted black line, we're actually not comparing it on a year over year basis. We're comparing it relative to 2019. Obviously, comparing it to a year ago, the numbers would look far more robust. We want to compare it to what was going on pre-COVID. And you can see that things like debit and credit card transactions, mortgage applications, so on and so forth, have all returned to pre-pandemic levels. And things like the number of people going out to dinner and the number of people passing through TSA checkpoints are really just a stone's throw from where they were at this point in 2019. And so you're seeing these high frequency indicators illustrate that the US economy really is coming back online here quite nicely. Again, very much leading the charge when we think about the global economy more broadly. Not only has this had to do with the pace and success of vaccination programs across the United States, it's also had to do with the response from the federal government. And I think it's important that we just pause and take a step back and think about all of the stimulus that's been pumped into the US and the global economy here over the course of the past 15 months. In the United States alone, we've spent more than or nearly $6 trillion vis-a-vis the federal government in response to COVID-19. And this was things like the CARES Act, the Paycheck Protection Program, obviously most recently another round of stimulus being implemented back in the month of March. And it appears that we're not done quite yet. It does look like we will get not one, but two infrastructure packages signed into law before 2021 comes to a close. And when we think about those infrastructure packages, we think that in general, they will come in a bit lighter than what the administration has currently proposed. And a lot of that has to do with the fact that the Democrats do look set to try to pass these bills using the budget reconciliation process. Now, on the one hand, that means that they can rely in the Senate on a simple majority of 51 votes rather than the 60 votes that are usually required to avoid a filibuster. But at the same time, relying on those 51 votes means that they can't alienate members of their party because then they won't be able to get these bills signed into law. And one of the big issues as it pertains to these infrastructure packages is the way that they are going to be paid for. You look at the charts over on the right-hand side here, looking at the deficit and the debt, both as a share of GDP. You can see that we are in the process of running deficits in the mid-teens during back-to-back years. We've pushed that debt to GDP level well above 100%. And for some time, we've been telling clients that the question of higher taxes is really much more a question of when, as opposed to a question of if. And we do think that higher taxes are going to be one way that the administration plans to pay for this infrastructure spending over the course of the years to come. But in general, when it comes to tax policy, we do think that the bark very well may be worse than the bite. And you've already heard from moderate members of the Democratic Party. They will support an increase in, say, the corporate tax rate from 21% to 25%, but not necessarily from 21% to 28%. And I think, when we think about some of the things that have been shared on the individual front, it feels like a bit of a stretch that, just as an example, capital gains taxes may skyrocket the way that is currently being discussed. But taxes are headed higher, and frankly, they need to. We need to figure out how to address this debt issue longer term. There are really three ways that you can deal with elevated levels of debt over time. You can either grow your way out of it, which is very difficult to do. You can inflate your way out of it, which is very risky, or you can pay your way out of it, which nobody really likes to do. And so, we think it's going to be a combination of all three. I'll touch on inflation more in just a couple of moments. We do think that economic growth will remain above trend, not only into the end of this year, but over the better part of next year. And again, we do think that taxes are headed higher, but not necessarily as much higher as the administration has laid out in their opening salvo. And so while all of these fears about higher taxes have been driven by massive amounts of deficit spending over the course of the past 12 to 15 months, all of that deficit fueled spending has also drummed up fears about the risk of higher inflation. And what we're showing here on this chart is an inflation heat map. And the way to read this slide is that a red square denotes inflation at the high end of a country's recent range. A blue square denotes inflation at the low end of a country's recent range. But importantly, a red square for one country and a blue square for another country tells you nothing about relative inflation. Everything on this chart is standardized to itself. And you can see that really for the better part of the prior cycle, there wasn't much inflation, not just in the United States, but more broadly around the world. That said, we do believe that this dynamic has begun to change, as evidenced by what we illustrate over on the far right-hand side of this slide. And we did just get an inflation report for the United States a couple of weeks back, which showed a continued acceleration in the pace of price increases. And we do believe that that will be generally the case across the majority of the developed world over the course of the next 12 to 18 months. But at the end of the day, the big debate is about whether or not inflation will prove to be transitory. And I would say that we side with folks like the Federal Reserve, and we do believe that this inflation will come, and then this inflation will go. There are really four main reasons in our view why inflation has been so low, not just over the course of the prior cycle, but really over the better part of the past 30 years. It's things like globalization, technological adoption, income inequality, demographics. All of these have structurally weighed on the pace of inflation over time. And absent a shift in one of those forces, we think that that will continue to be the case over the course of the years to come. So the recent inflation we've seen has been driven by increases in things like airfare prices, increases in hotel room prices, obviously goods in general. I'm in the process of renovating a home. I can tell you it gets more and more expensive every single day. We believe that those things will be transitory, and over time, these more structural forces will end up winning out. But we do ask ourselves, okay, so we think that inflation will be transitory over time. But what could cause that to not be the case? And, obviously some sort of policy from the federal government that leads to significant wealth and income redistribution, a kind of anti-globalization sentiment taking hold, technological adoption no longer occurring. To me, that feels like a bit of a stretch. To me, the elephant in the room when it comes to what could lead inflation to be stickier than what a lot of people have penciled in has to do with wages. And what we're looking at here on this chart, the gray line represents the unemployment rate. The light blue line represents wage growth. And you can see over on the far right-hand side of the chart that wage growth actually spiked as the unemployment rate moved higher when the pandemic took hold at the beginning of last year. And part of what happened was that the composition of the labor market shifted quite drastically. And a lot of those low income workers fell out of the labor force, right? It was people concentrated in the services sectors, things like financial services, law, technology, right? They simply shifted and began working from home. And in aggregate, that made wage growth look more robust than was actually the case. Now, as these lower income workers have come back in, as restaurants have reopened, as bars have reopened, you might even expect wage growth to dip negative on a year over year basis. But we've actually seen wage growth remain positive. And what this is signaling is that there is a tremendous amount of demand for labor but there is a somewhat limited supply. I'll tell you all a story. So I have a 2-year-old daughter. My wife and I and our daughter used to live in New York City. The pandemic came. We said, this isn't working. We went and lived with my parents in Connecticut for a while, ended up buying a house, and Connecticut is now where we call home. We actually moved back to the town where I grew up, which is a little bit of a full circle if you're me. But what I'm getting at here is I went to get pizza the other night, and I was talking to the guy, Lorenzo. He runs the pizza shop in town. He's about my age. His father ran the pizza shop before him. And he was saying to me how he now needs to be closed on both Mondays and Tuesdays because he can't find people to work at a wage that he is willing to pay. And part of this is being driven by what's happening from a benefit side, right? If courtesy of the federal government, you can make more than $15 an hour staying at home, collecting enhanced unemployment benefits in the current environment. But again, at the same time, you're beginning to see minimum wages rise vis-a-vis the private sector. You know, people, firms like Walmart, firms like Amazon, firms like Bank of America, all increasing the minimum wage for their lower income employees. And we do ask ourselves, you know, if there's this demand and you're seeing that demand and lack of supply, that adjustment happen vis-a-vis higher wages, if wage growth proves to be more robust, if wage growth proves to be stickier than what a lot of people expect, and certainly than what we saw during the better part of the prior cycle, I do believe that perhaps inflation may be less transitory than, again, what a lot of folks currently expect. But, you know, this dynamic matters most for our friends at the Federal Reserve. You've heard Jay Powell and other Fed officials time and time again come out and say, you know, we believe that this inflation will be transitory. We are laser focused on the labor market. We are not worried about what happens with inflation until we get back to full employment, because we believe that these elevated rates of inflation that are currently being observed will end up running their course. And again, our base case is that, you know, that will be the way things play out. But if you look at the Fed's forecasts, they're actually a little bit inconsistent. They did have a meeting last week. They are now looking for a couple of hikes before the end of 2023. But if you look at those economic forecasts up in the top right-hand corner, you know, the Fed thinks that economic growth is going to remain well above trend through the end of 2023. They think that the unemployment rate will fall below a level of 4% sometime during 2022. And they expect that while inflation is going to pick up here in the short run, it'll settle in at about 2% in the long run. And they think that's only going to require 2 rate hikes over the course of the next couple of years. I think that's a reasonable place to start the conversation. But the reality of the situation is that nobody knows what the world is going to look like by the time we get to 2023. And so the most important thing that I believe we should all be doing as investors is watching the data closely. The Fed responds to data. And if the data begins to show that inflation is not as transient as everybody has penciled in, then we will need to adjust our views on the trajectory of monetary policy. But our base case here is that at Jackson Hole in August, the Fed will formally announce when they plan to begin their tapering program. We believe that that first rate hike may come as soon as the end of 2022, more likely coming at the beginning of 2023. But again, this is going to be dependent on the data. And once the Fed gets the labor market back to full employment, they are going to begin to focus on inflation. And depending on what's going on with inflation at that point in time, those forecasts may prove to be a bit lighter, a bit more dovish than what actually ends up coming into play. So in general, I think that the economic setup is pretty decent. You know, you have a virus that's being brought under control. You have a global economy that is coming back online. You have monetary and fiscal policy, which at least for the time being are both set to remain accommodative, and generally a view that inflation will prove to be transitory. But there are challenges and opportunities that have come out of the pandemic across the capital markets. I would argue that the biggest challenge we face today, particularly as long-term investors, is the fact that basically wherever we look, assets look expensive. Now, what we've done here on this chart is tried to take the valuation, or what we proxy as the valuation of a 60-40 stock bond portfolio, and show people where things currently stand relative to the past 40 or so years. And you can see that as of Friday's close, a 60-40 stock bond portfolio was almost as expensive as it has ever been, right? Part of this is the fact that interest rates remain very low, part of this has to do with the fact that equity valuations, yes, they've come off the boil, but in general, they remain fairly rich. And so the question is, what do you do about it? You know, a lot of clients that I speak with, they lament what's going on with valuations. Oh, bonds are so expensive and rates are headed higher. Stocks are so expensive, and that means muted forward returns. You know, the good investor doesn't complain about the hand that they're dealt. They figure out how to play the hand that they're dealt. And so what we've spent most of our time doing over these past couple of months is looking across the markets and saying, okay, well, you know, where are we finding pockets of value on a relative basis? Are there things that look cheap? And we've actually uncovered a number of opportunities despite this aggregate challenge. Now, the elephant in the room when it comes to the capital markets going forward is really the direction of interest rates. And what we're showing here on this chart is the current level of the current shape of the yield curve, and that's the blue line. The shape of the yield curve at the end of 2013, which is in the aftermath of the taper tantrum during the prior cycle, the yield curve in August of last year, when it was arguably at its flattest, and then the range that the yield curve has been in over the course of the past 10 years. And you can see that there is certainly room for long-term interest rates to rise. You know, we don't think that the Fed is necessarily going to touch the short end of the curve anytime terribly soon. But we do believe that over the course of the next 12 to 18 months, you will see long-term rates trend higher. We think that the 10-year Treasury yield will finish 2021 at a level of around 2%, and then likely somewhere between 2.25% and 2.5% by the end of 2022. And so a rising rate environment in and of itself presents both challenges and opportunities within fixed income as well as equities. You know, fixed income, let's just put it bluntly, obviously it's tough to invest in bonds when interest rates are moving higher. And as a result of that, we've really gone to taking a barbell approach when it comes to allocating across this part of the capital markets. And what we're showing here on this chart, the position of the diamonds relative to the x-axis represents the correlation of each of these sectors to the S&P 500. And then the position of the diamonds relative to the y-axis represents their average yield over the past 12 months, hedged back into US dollars in the case of those international markets. And you can see that to a certain extent, the bond market is broken. You look down in the bottom left-hand corner at things like US Treasuries. These assets provide protection in theory, but don't necessarily provide all that much income. And you juxtapose that with what we show in the top right-hand corner of the chart, things like high yield and EM debt. You know, these assets very clearly provide income, but they don't really provide any protection. And so given that bifurcation that we see across the fixed income universe, we're big believers in taking a barbell approach. Now, when it comes to building the core of our fixed income portfolios, we're actually beginning to gravitate a bit away from things like US Treasuries. We do think that to a certain extent here, Treasuries are making a transition from being the risk-free rate to the rate-free risk. We still want to have some duration vis-a-vis Treasuries in our portfolios, but we want to complement that core with things like investment-grade corporates, securitized paper, municipal bonds, particularly given a view that taxes are headed higher here over the course of the years to come. And then we want to complement that core allocation with extended allocations, allocations to the more extended parts of the fixed income universe. And this is things like high yield, places like EM debt, floating rate loans obviously look attractive given the outlook for rates more broadly, but we do not want to bottom fish when it comes to these extended sectors. We are very much maintaining a higher quality bias because effectively we believe that a lot of the cracks that we're beginning to form in the bond market as the pandemic took hold were simply papered over by very easy and very aggressive fiscal and monetary policy. And as those policy supports are gradually withdrawn here over the course of the years to come, we do believe that those cracks may reemerge, and that informs our higher quality bias across fixed income more broadly, but particularly as it pertains to those more extended markets like high yield. Now, when it comes to generating income, obviously the bond market doesn't do what it used to. You go back to the 1990s, You could buy a 10-year treasury. It would give you an inflation-adjusted return that you could live with. It would zig when the equity market zagged. That is really no longer the case. What you can see on this chart, particularly down at the bottom, is the plethora of income-producing opportunities that exist in the current environment, right? It's not just about fixed income. It's not just about EM debt. It's not just about high yield. It's about incorporating things like preferred stocks, REITs, even plain old international equities pay you more than you're getting on the 10-year in the current environment. And I would add that for clients who can handle a bit of illiquidity, going into private markets is a great way of enhancing your stream of income without adding equity risk to your portfolio that historically has not been as accessible to individual investors as is the case in the current environment. So we see ways of generating income outside of traditional fixed income. And we think, again, that, much like my 2-year-old daughter prefers to color with a box of 24 crayons rather than a box of 12, we shouldn't just think about income producing opportunities within the fixed income universe. We need to think about those income opportunities and where they exist across the capital markets more broadly. Now, if we switch gears a little bit and think about the impact of rising rates on equities, everybody has a story here. And a colleague of mine, Michael Semblist, recently wrote a piece called "Interest Rate Pretzels," which described all the different ways that people try to talk about the relationship between interest rates and the stock market. Now, what we've done on this chart is we've tried to lay it out very cleanly and very simply. What we're looking at here, the position of these diamonds relative to the x-axis represents the 10-year treasury yield at each of these given points in time. And then the position of the diamonds relative to the y-axis represents the correlation between changes in rates and changes in equity markets. And we actually took it one step further, and we looked at this both before and after the financial crisis. So those gray diamonds represent the period from 1965 through January of 2009. Those green diamonds represent the period from February of 2009 to the present. Now, what you see is that from 1965 through January of 2009, stocks and interest rates could move together until the 10-year yield hit 4.5%. At that point, they would begin to move in opposite directions. We recognize that that threshold has declined since the financial crisis, and we think that the magic number is now somewhere closer to 3 or 3.5%. But I would make 2 points here. One, yes, there is room for rates to continue to rise before they become a problem for the equity market, but the pace at which rates rise really matters just as much. And one of the things that gave equity markets and risk assets broadly such bad indigestion earlier on this year was the fact that we were seeing these 2 standard deviation moves in the treasury market on a weekly basis, and that's enough to destabilize any asset that prices off treasury yields when all is said and done. And so we think that there's room for rates to rise, but we think the pace at which rates rise is equally important. That said, the primary way that rising rates pressure equities is through valuations, right? Higher interest rates mean that the forward PE ratio, or whatever valuation you prefer to look at, that valuation arguably needs to decline. And so if rising rates cause forward multiples to decline, then earnings become more important as an overall driver of returns. What we're showing here on this chart is the year-over-year change in S&P 500 operating earnings. And then we've broken that down into the share of earnings growth that comes from margins, the share of earnings growth that comes from revenues, and the share of earnings growth that comes from buybacks, or broadly speaking, changes in the share count. And you can see over on the far right-hand side, this is actually Standard & Poor's estimate, not our own estimate, but Standard & Poor's believes that S&P 500 operating earnings will grow to the tune of 55% here in 2021. Our own forecasts are a little bit lighter than that. We're more in the 45 to 50% camp, although we've upgraded those estimates over the course of the past couple of weeks. What's arguably more important here is that where the earnings growth is going to come from looks set to be very different than what we saw during the pandemic in 2020. And you think about last year and where the earnings came from, it was really all about 3 sectors. It was about technology, it was about healthcare, and it was about consumer staples. As we think about the sectors that are going to drive earnings growth this year, it's more about the cyclical parts of the equity market, areas like financials, industrials, materials, even energy. And given that those names on a relative basis do look more attractive from a valuation perspective, we think that investors should embrace that cyclicality, embrace that reflation trade. And taking it one step further, we do believe that this trade still has room to run. Now, a lot of people, when they talk about growth versus value or cyclicals versus defensives and quality, they point to charts like the one on the left-hand side, and they say, you should buy these stocks because they're cheap. If anybody's been to the dollar store, they have a lot of cheap stuff at the dollar store that you probably don't want to take home with you. We are always looking for assets that are cheap, but look set to perform well in the macro environment that we believe will materialize over the course of the next 12 to 18 months. And when we think about that macro environment, and we talked about it at the beginning of the call, it's one which is going to be characterized by robust inflation, very robust economic growth, and at least for the time being, fairly accommodative policy. And so we recognize the valuation advantage that we show on the left-hand side of this chart, but to us, it's really much more about the chart on the right-hand side. And what we're showing here is the correlation of each sector's earnings to the overall pace of real economic growth. And again, you can see that industrials, financials, energy, those sectors are most levered to overall economic activity. And so in an environment where the US economy grows, well above its potential, we think the economy could grow by more than 7% in real terms this year. You would expect that to provide a disproportionate benefit to those more cyclical parts of the market. And so we're sticking with the financials, we're sticking with industrials, we've warmed up to energy, and oil prices continue to trend higher here. The question of does this still have room to run? I think that the answer is yes, as we do think that rates and growth will remain on an upward trajectory during the second half of this year. Now, I see we got a question here, so I'm just going to take a quick pause and see what the question is. Yafal, I see that you've raised your hand. If you'd like to unmute yourself, I'd be happy to take your question before we carry on with the presentation. He says to just ignore him, so we will carry on with the show. And again, there will be plenty of time for questions at the end, so feel free to raise your hand, or again, there will be time for everybody to ask at the conclusion of the presentation. And so, we've talked a little bit about what's been going on in the global economy. We've talked a bit about the outlook for fixed income and some of the challenges and opportunities within U.S. equities. I do want to make the point here that while we like value on a short-term basis, we still acknowledge the long-term secular opportunity in the growthier parts of the market. And you look at this slide in front of you, whether it's growth in electric vehicle sales, whether it's a focus on R&D, whether it's the prevalence of semiconductors across all of the things that we use on a day-to-day basis, right? These growthier parts of the market, these more forward-looking parts of the market still play a very important role in portfolios. And so the way that I've been framing it to clients over the course of the past couple of months is you want to own growth and rent value. Again, we see a tactical opportunity here in things like energy and financials, but we also recognize that trees don't always grow to the sky. And so it's really about overweighting one relative to the other. And we believe that over the next 10 to 15 years, it will very much be these more secular growth opportunities that really drive outsized returns within the context of balanced portfolios. Now, I want to shift gears here and talk a little bit about our outlook for international equities. Before I do, you can't really have a conversation about international equities without acknowledging the outlook for the US dollar. We came into this year with a view that the dollar was going to weaken. That is very much what has played out in general. We have seen periods where the dollar has paused. We've seen a few periods of dollar strength, but we do believe that into the end of this year and the beginning of next year, we will see the dollar continue to trend lower as global growth becomes increasingly synchronized. And furthermore, looking at that chart in the bottom right-hand corner, as the difference in interest rates between the United States and the rest of the world gradually begins to narrow. So we think that the dollar can weaken here in the short run. We do believe that the dollar can weaken longer term as well. And what we found over time, if we look at that chart in the top right-hand corner, that the long-term trajectory of a country's currency is really a function of their trade balance or their current account balance. And you can see up in the top right-hand corner of this slide that the United States runs a chronic current account deficit. So put differently, we are a net borrower of dollars from the rest of the world. What this means is that over long periods of time, the dollar should gradually weaken, taking what was a significant headwind during the prior cycle and allowing it to evolve into more of a tailwind over the course of the years to come. And so we think that the opportunity in international equities really is growing. And I, for one, am much more constructive on this asset class than I have been in quite some time. Again, Wall Street has relied on charts like the one on the right-hand side to make the case that you should buy international equities because when all is said and done, they continue to look cheap. Again, we want to find assets that are attractively valued and then own them in an environment that is supportive of their outperformance. And we talked about our preference for value over growth within the context of US equities. If you look at that chart on the left-hand side, particularly the blue diamonds, what you'll see is that the rest of the world tends to be far more cyclical. It tends to be far more value-oriented than is the case here in our own backyard. And so if you agree that it makes sense to embrace value and embrace the reflation trade within the context of the United States, then arguably you should be embracing markets outside of the US as they tend to have more of a value orientation than, again, what we find in our own backyard. So we're finally finding things to do in places like Europe. We continue to like the long-term outlook for the emerging world. And furthermore, we would be of the view that when it comes to the United States, large cap US equities, that's a pretty efficient market. It's very difficult to add alpha when you have 40 analysts that are all covering the same company. When you begin to look either down the capitalization spectrum, and I should add that we like small caps in the current environment as well, when you begin to look outside of the United States, you find markets that are simply less efficient than what we have in say, the S&P 500 universe. And I think that this chart on the left-hand side does a great job of illustrating the opportunity that has existed in markets outside of the US, despite a period where international markets certainly were a bit out of favor. And everybody knows that technology has done very well, and US growth stocks have done very well. What not a lot of people realize is that since the beginning of 2015, European luxury good makers have actually outperformed US growth. EM Tech has outperformed both European luxury and US growth. There are always things to do outside of the United States. You simply need to know where to look. And I would take it one step further and point to that chart over on the top right-hand corner. When you think about investing outside of the US, you need to think about the type of revenue exposure that provides at the end of the day. What we're showing here is the share of total revenue that comes from the home country. So if you look at that second bar in from the right, 60% of US equity market company revenue comes from the United States. Juxtapose that with someplace like Europe over on the far left-hand side of that chart. Only 45% of the revenue generated by companies in the MSCI Europe actually comes from Europe. And so again, if you believe that global growth is going to become increasingly synchronized, if you believe that this very robust economic activity still has room to run, not only embracing cyclicality in the United States, but again, embracing opportunities outside of the US, we really think will be the case to successful alpha generation over the course of the years to come. So we've talked about the economy coming back online and all the things that are going quite well from an economic growth and a policy perspective. We've talked about ways to invest in a world where valuations are rich, where we're finding opportunities in fixed income, where we're finding opportunities in US equities, and where we're finding opportunities outside of the United States as well. I want to wrap up with a few thoughts around volatility and portfolio construction. And I want to start with this slide from our guide to the markets. Now, JP Morgan Asset Management, we produce this 70-page chart pack. We actually update it every single day. And this is arguably the most used slide in the entire book. And I think the reason why is because the message is so simple, but the message is also so important. What we're looking at here, the red dots represent the peak to trough decline for the S&P 500 each year back to 1980. And then those gray bars represent the full calendar year return. Now we put the punchline right up in the subtitle. On average, during the past 41 years, the stock market has fallen by about 14% during the course of the year. However, in 31 of those 41 years, the market has then gone on to finish the year in positive territory. So put another way, if the S&P 500 was a baseball player, it would be batting more than 750. It would be the best hitter in Major League history by a factor of 2. What this chart shows us is that volatility is normal, volatility should be expected, but equity markets are resilient. And look, there's a lot of good news in the price right now. We've effectively had an uninterrupted rally in risk assets since we got the vaccine news on November 9th of last year. And when we think about the outlook for volatility, the way that I think about it is, well, we're kind of due. I don't think we're going to have a 20% correction. I don't think that we're going to see the whole house come toppling down. But I do believe that as the economy reopens here and as things come back online, investors are going to begin to ask that fateful question of, well, okay, what happens next? And as they look out over the years to come, what are they going to see? A return to trend growth, less accommodative monetary policy, less of a role played by fiscal policy. There are a lot of things that investors are going to begin to grapple with here over the course of the next couple of weeks and months. And I do believe that that will drive some volatility in the equity market over the better part of the summer. But we remain constructive on risk assets longer term. And we think that the key there is really to take a longer term view. What we're showing on this chart are the best and worst 1 year, 5 year, and 10 year and 20 year rolling annual returns for stocks in green, bonds in blue, and a 50-50 portfolio in gray. Now, what you can see very clearly on this chart is that by taking a longer term view, you can reduce short-term volatility. So you look at that first set of bars over on the left-hand side, the best 1 year return you got from stocks from 1950 through 2020, you were up 47%. The worst, you were down 39. The best 1 year return you got from bonds, you were up 43%. The worst, you were down 8. The best 1 year return you got for the 50-50 portfolio, you were up 33%. The worst, you were down 15. What this says to me is that no matter what somebody might tell you, no one has any idea what the capital markets are going to do over a 12-month period of time. But if you take a step out to that second set of bars from the left and look at 5-year rolling periods, something really interesting begins to occur. You look at the best 5-year rolling return for the all equity portfolio, up 28% a year. The worst, down 3. You look at the best 5-year rolling return for fixed income, up 23% a year. The worst, down 2. And then you look at the best 5-year rolling return for the 50-50 portfolio, up 21% a year. The worst was up 1% a year for 5 years. Now, this does not include fees, but think about the message that this chart sends. There was not a single 5-year rolling period from 1950 through 2020 where a 50-50 portfolio of US stocks and US bonds lost you money. Now, a lot of people will then say, they'll point to the bars on the far right-hand side. Well, David, according to that theory, I should just sit in equities because, the worst I could have done was 6% a year. The best I could have done was 17% a year. Yes, that's true. But what would you have done in the year where the market was down 39? A lot of people would have jumped ship. And so we believe that taking a balanced and long-term approach is really the key to successful investing when all is said and done. And you can see on this final slide here that looks at the annual returns of a number of different asset classes over the past 15 years, alongside a balanced portfolio comprised of those different asset classes, which is the gray box connected by the black line, that balanced portfolio, it's never the best performer, but it's also never the worst. It trends right along the center of the chart, providing investors with a smoother ride over extended periods of time. And look, I will be the first to admit that diversification works over time. Diversification doesn't work every time, but diversification certainly worked in your favor during 2020. Arguably, one of the best things you could have done was nothing as the pandemic was taking hold. And we think that given the uncertainty that continues to exist around the direction of travel for both the economy and the capital markets, a balanced and diversified approach will pay dividends over the course of the years to come. At the end of the day, we're big believers that if we can keep the ride comfortable, we can help keep people invested. And if we can help keep people invested, we can improve the chances that they successfully accomplish their long-term investment goals. So with all that said, I know we covered quite a bit today, and it is a Saturday, so thank you all very much for your attention. And with that, I'd be more than happy to take any questions during the time that remains. And so Evan, Jeff, maybe I'll pass it over to you and we can dive into some of the Q&A.
Let me start with something that a lot of people aren't aware of, that I've been following Guide to the Markets for years. It's one of the best resources out there. I'm wondering if you could do two things. Give a little bit of background. I remember the days when it would come out in a spiral little booklet, and I look forward to that, and I'd spend about an hour going through it. And now you say it's updated daily. Second of all, how can our attendees access that great resource?
Absolutely. So the Guide to the Markets, the Market Insights program, of which the Guide to the Markets is a part, was started back in 2004 within the asset management business at JP Morgan. And really, it's kind of funny. The way that it came to be was we kept on getting requests. Can you make a chart of US GDP? Can you make a chart of S&P 500 earnings? And all of a sudden, what we realized was we had 30 or 40 charts that people were asking us to update. So we said, you know what, let's make a book. Let's create the Guide to the Markets. And over time, it's grown and grown and grown. In a pre-COVID world, we distributed about 250,000 hard copies to financial advisors around the world every single year. And taking it one step further, we've gone from, Evan, as you noted, updating the book quarterly to now updating the book daily on our website, jpmorganfunds.com. So a couple of ways to access this resource. If you go to jpmorganfunds.com/insights, you will arrive at the Market Insights landing page and you'll be able to navigate to the guide. If you also just Google JP Morgan Guide to the Markets, it'll come right up at the top of the search list. And so a number of ways to access the resource. And I would just add that our team does more than produce the Guide to the Markets. We write papers, we write blogs, we record videos. We're really meant to be an objective research team within our asset management business more broadly. And so please feel free to jump on our website, poke around, and don't hesitate to reach out if you ever have any questions.
Jeff, you have anything? Or
Yeah, I've got a question. Question on inflation. I notice, I watch CNBC a lot. I see a lot of people talking about, the money supply is expanding at double-digit rates. And so, they say, well, it means inflation is going to go crazy. But at the same time, I noticed that the velocity of money has just been falling like for several years. The last chart I saw of it, it kind of bottomed out. But what are the determinants that affect the velocity of money? And if the velocity of money is going to increase in the future, wouldn't that create a lot of inflation?
So it's a fantastic question. And when we were talking about inflation earlier, I actually alluded to income inequality as being one of the things that we believe has kept a lid on inflation over time. If you look, what you'll find is that more than 50% of total pre-tax income in the United States accrues to the top 10% of earners, right? So the majority, more than half of the income that's generated each year goes to the top 10%. And then you take it one step further and you look at the way that people spend money. The top 10% of earners spend 64 cents of every dollar that they earn. They save the rest. The bottom 90% of earners spend 99 cents of every dollar that they earn. And so what's happened here is that as income has flowed to people who save it rather than spend it, yes, the money supply has expanded dramatically, but the velocity of money, Jeff, to your point, has really continued to move lower. And so until we see things that redirect that income and that wealth to people that are actually have that higher marginal propensity to consume, right? They have that extra $100 in their pocket and they go out and spend it. Until we see that begin to play out, again, we think that inflation will remain in check. But coming back to the point on wages, we're seeing lower income individuals command higher wages. And that does lead us to question whether, again, this inflation will prove to be as transitory as folks like the Federal Reserve currently expect.
How how high do you think inflation could get?
So we think that we'll finish this year. The Fed looks at the personal consumption deflator, or PCE, which is arguably a better measure of inflation than CPI.
Right.
We think that PCE, headline PCE, will be somewhere around 3.5% by the end of this year, but then fall back to somewhere between 2 and 2.5% by the end of 2022. And so, what we're seeing right now on a year over year basis is very much peak inflation, because the comparisons are very favorable. And, last year, this time is when inflation was really bottoming out. That said, we do expect inflation to remain relatively robust over the course of the next 12 or so months before coming back into that 2% level again sometime in late 2022 or early 2023.
Yeah, I guess the economy, kind of like almost very similar to like the end of World War II, when all the soldiers came home, but then all the manufacturers, they had to retool from wartime production to peacetime production. So you got a bunch of shortages. So you had a spike in inflation, and over the next year, it came all the way down.
Exactly. And there's actually been some very interesting work done by a group, I believe at Yale, where they looked at the way people spend money. And effectively what they found is that, if you spend $100 a month and you usually spend $50 on goods and $50 on services, during the pandemic, you just spent $100 on goods. And so not only did we have these supply chain disruptions, i.e. the Suez Canal incident, but you had people that could only consume one thing. And so they did it in spades. And that's why you're seeing the price of lumber, until quite recently, continue to move higher. That's why you're seeing the price of goods remain so elevated. But we do believe that those are transitory. And as people can consume a better mix of goods and services, we do believe that goods inflation will begin to gradually subside.
Right. Okay.
Let me ask a different question about increasing wages. If wages are increasing because of demand, supply, as well as maybe minimum wage laws, what are the investment implications of people that were making $9 or $10 an hour now making 12 to 15?
So the most significant implication is that margins will come under pressure. Profit margins will come under pressure unless that increase in costs is able to be passed through to the end consumer. And one of the things that we saw during the last cycle, I wrote a blog on this a couple of weeks ago. So the question feels like a little bit of a tee up, but that's good because I actually have something interesting to say. What you saw during the prior cycle was that corporations, businesses would increase wages, but everybody was too scared to increase prices. What you're now seeing is that small businesses in particular plan on increasing wages and prices over the course of the next couple of months. And so I do think, again, there's a risk that you see these higher input costs, these higher wages passed through and manifest in the form of higher prices, because if not, corporate profitability comes under pressure. And to just put it bluntly, right, businesses are in the business of making money. And if they're not making money, they oftentimes do something about it. So then you begin to go down the road of automation and things of that nature as ways of controlling costs in a world where wages are rising a bit more aggressively than was the case over the prior expansion. And so again, to me, it's not about focusing on the inflation data itself. It's really much more about focusing on what's going on in the labor market, and particularly what's happening with wage growth among those lower income individuals.
On that, well, it's kind of stretching it, but somebody was asking about, with the increase of electric cars, what are the implications for copper? And I guess that ties into inflation, a little bit of emerging markets, all of that. It expands pretty widely.
No, it does. I read a research report the other day called Copper Everywhere. And I thought that summed it up quite nicely, because copper is such a significant input, not only into electric vehicles, but into renewable products more broadly, particularly things like wind turbines. And so we think that there's going to be demand for industrial metals going forward. And we do believe that commodities may perform a bit better over the course of this cycle, certainly than they did over the prior cycle as they were dealing with a bit of a hangover from China's industrialization in the early 2000s. But at the same time, Evan, you point out, commodities and inflation are oftentimes mentioned in the same sentence. And one of the things that we found is that every 1% move in inflation tends to correspond to a 10% move in commodity prices. And so whether you think about demand for renewable energy, whether you think about demand for electric vehicles, or you think about demand for other products where copper is an input, right, that in conjunction with higher rates of inflation, arguably will continue to put upward pressure on prices, not just over the course of the next couple of months, but more broadly over the course of the next couple of years. And so we struggle to paint with broad brushstrokes when it comes to commodities in general, but we do think that places like the industrial metals are really what stand to benefit the most from the economic outlook that we currently have as we think about the direction of travel.
Okay, let me ask another one about asset allocation. And this irks me a teeny bit because people say, what should be my asset allocation? And well, all sorts of questions. How old are you? What other assets do you have? How much income do you need every month? Or are you, 40 years old and saving? Are you 70 years old and taking money out? But in general, how would you handle the asset allocation question so you can be in those white boxes and do pretty well?
So I think that when I think about portfolios, I kind of think about them backwards, from a lot of people. And I start with, well, what's the outcome you're trying to achieve? And then let's figure out the assets that will help drive that outcome. And so, if you need cash flow, right? If you can't afford to take a whole lot of risk in things like equities because you're later on in life, right? You're going to want to have an asset allocation that is more weighted to those defensive income producing assets as opposed to things like equities or commodities. On the other hand, if you're somebody like myself saving for, my daughter's college tuition, I'm taking all the risk I can because the time horizon is such that, going back to the chart that I just pulled up on the screen, right, over time, taking a long-term view can actually be your friend in reducing volatility. And so, we always think that kind of a 50-50 blend is the right place to start, 50% stocks, 50% bonds, and then moving away from that really depends on what you're trying to accomplish in your portfolio, right? Are you focused on capital appreciation? Are you focused on increases in price? That's going to drive a greater weighting towards equities. On the other hand, if you're more focused on playing defense, maybe generating a bit more income, then despite the level of yields, you're going to want to continue, you're going to want to lean more heavily into things like bonds. And so, to your point, it's really on a case-by-case basis, but that's the way that I think about it from a 20,000-foot view.
Okay, I got a question. On the 10-year Treasury note, I've seen charts that equate the 10-year Treasury yield with nominal GDP growth, I guess, over long periods of time. So I guess going forward, if nominal GDP growth, which is real GDP plus inflation, is like 4%, yearly going forward. So doesn't that mean the 10-year Treasury should be about like 4% like going forward, but it's so low, it's less than 1.5.
So that the cocktail napkin math there works in general. It tends to work over longer periods of time. So say, looking at a 5-year average, right, is going to be a little bit of a cleaner way than looking at, just as an example, where we are today. I think it's also important to recognize the role that central banks are playing in the current environment. The Fed is scooping up billions of dollars of treasuries every single month. The ECB is buying bonds, Bank of England buying bonds, Bank of Japan buying bonds, and all of that is exerting downward pressure on the long end of the curve. And so as we begin to see policy accommodation gradually removed, again, this kind of feeds into our thesis that long rates will drift higher. And actually, one of the other things I do at JP Morgan is I help with our long-term capital market assumptions. And we believe that over the next 10 to 15 years, we'll end up with a 10-year Treasury yield somewhere to the tune of, call it 3.5%, 4-ish%. And so we get there, but we get there over time. And I think it's important to recognize what central banks and policy are doing in the current environment to actively keep rates low in an effort to spur above trend economic growth.
Right. So let me ask you this question. If interest rates are going to go up gradually over time, I've seen charts that show a negative correlation between technology stocks and interest rates. And like right now, the S&P is like 30% technology. So what do you say to that?
So I do recognize that relationship. I also think that a lot of technology companies trade on stories and expectations as opposed to actual earnings. And so back to what I said earlier about higher interest rates pressuring valuations, right? If you're a company that's not generating any earnings and it's just you're a story stock, for lack of a better term, yeah, you're going to get clobbered when rates actually begin to rise. But as a very wise investor put it to me recently, and this is not a recommendation, it's just an example, Apple and Google are going to make money whether the 10 years at 2 or 3. Right. So focus on the cash flow, focus on the earnings, and identify those companies in those secular parts of the market that have the potential to generate high quality streams of earnings over time. To me, that's the best way to be successful and kind of bridge that gap between rising rates and the pressure that it'll put on tech stocks in aggregate. Right. It's really about picking and choosing your spots and focusing on those earnings.
Okay. One other question. You know, I've been reading a lot about this Delta variant, the one from India, and you know it's here in the United States. And I hear some things that the vaccines can defend against it, but at the same time in England they seem to be having a big uptick. I guess it's in younger people. Like, how big of a problem is it here, and is it gonna like trip up the reopening of our economy?
So I think what's really interesting is that despite the US and the UK kind of leading the charge on vaccination globally, they've actually taken very different approaches beneath the surface. In the UK, they said, let's give everybody one shot, right? So let's get it into as many people as we can, and then we'll focus on the second one. In the United States, I went and I got my shot, and a couple of weeks later, I came back and I got my second, and that was just the way that it worked. And what they found is that particularly the Moderna product and the Pfizer product, which are the two primary vaccines in the United States, they're still fairly effective against that variant. It's become an issue among younger people who aren't vaccinated, maybe only have one shot. To me, it is a risk that shouldn't be ignored, but it is not the thing that's sitting on top of the league table in terms of what I'm thinking about from a risk perspective over the course of the next 12 to 18 months.
Okay. Evan, did you have another question? Evan?
Yes, I was having something. A couple of questions. We can't let you go without asking about Bitcoin and gold. So anything on those topics?
Sure. So here's what I would say. If you talk to somebody at JP Morgan who's been there for 30 or 40 years, they're going to say, crypto, well, it's kind of like tulips, right? I don't buy it. You talk to a first year analyst and they probably put their whole bonus into Bitcoin or Ether or one of these digital assets. The way that I think about it is that they're not going away anytime soon. I think part of it is a function of money looking for a home. I think part of it is a function of a generally populist sentiment and a distaste for the status quo. But I think that going forward, to me at least, these digital assets are not necessarily currencies, but they're not necessarily going anywhere either. And so one of the things that we've spent a lot of time doing is saying, okay, so the Federal Reserve has been working on this project for years called FedNow, and it's coming in 2023. It's basically going to be a digital way of transacting. One could argue that if you're going into a coffee shop and you want to get your morning jolt before you head to the office, and I do think we're all going back to the office, it's going to be much easier to pay with the Fed app than it is to try to pay with Bitcoin, unless all of a sudden people can begin to accept it far and wide. And so it's not really a currency. To me, it's more of an asset. But figuring out how it fits in a portfolio is really where it becomes quite challenging, because if you think about a traditional mean variance optimization framework, right? So you look at the volatility of the asset, you look at the expected return, and then you look at the way that it's going to interact with the other assets in a portfolio. depending on the look back period, right? Let's not even try to forecast. Let's say you use average 3-year, 5-year, and 10-year numbers for Bitcoin. You are going to get drastically different suggested allocations depending on which time period you use. And so, to me, we see people using it as a hedge. We see people using it in a speculative fashion. To me, it's not a silver bullet, but I don't run for the hills when clients ask about it, because you see it showing up on corporate balance sheets. You look at the growth in the infrastructure surrounding this industry. And I think, we've seen enough resilience from these assets over time that I don't think they're going to be here today and gone tomorrow. I think they may begin to fade into the background as they are more broadly adopted. And some of the things that people like about them, i.e. the return that they've generated, begin to become more difficult to come by. You may begin to see them take a backseat to other assets, but I'm certainly not of the view that they're just going to go and completely disappear. That said, best thing I've heard on crypto, if you're going to own it, you have to be prepared for it to go to zero. Period, hard stop. Because at the end of the day, right, it's a asset, it's a commodity, and it's only worth what somebody will pay you for it. There are no cash flows to discount. And so similar to gold in that sense, but obviously very different from gold from a volatility and a correlation perspective, which is where all the math and kind of analysis starts to get particularly interesting if you're somebody like myself.
Okay, and going to the opposite extreme, this will be my last question, would be two-parter. Is the 60-40 dead? And where do we stand, value versus growth, small versus large?
So on a tactical basis, I would prefer value to growth and small to large. Is the 60-40 dead? Depends on the 40. When we talk to clients about it, it's to me, it's again, not as much about saying you need to have this much in stocks and you need to have this much in bonds, more about trying to figure out the outcome you're trying to achieve and then backing into the assets that will provide that solution. Furthermore, we do see a role for alternative assets and alternative strategies as well within the context of diversified portfolios going forward. And I actually produce a sister publication called The Guide to Alternatives that looks at things like real estate, infrastructure, both public and private, liquid, illiquid alternative strategies. And I think if nothing else going forward, again, it's going to be about painting with a broader color palette. The other question that people ask me all the time is, okay, well, active versus passive. And my answer is, well, a little bit of both, right? It depends on the efficiency of the asset class that you're discussing. It's not necessarily about stocks and bonds. It's about stocks, bonds, and alternatives. And within that alternatives bucket, right, there are lots of different levers that you can pull depending on the outcome that you're trying to achieve. Private equity isn't right for everybody, but for somebody who has a 15-year view, maybe that does add value in a world of muted expected returns. So is the 60-40 dead? No, but I would say that the 60-40 portfolio is in a bit of an evolution, given the level of rates and the valuation of the stock market quite broadly.
Okay, Jeff, I'll give you the last question, and then David, the last word.
Oh, all right. Well, here's another question. You had that chart of federal debt to GDP ratio. So I guess my question is, it has to do with the law of diminishing marginal returns. So when the debt to GDP ratio is low, let's say 20 to 30% of GDP, and you add more debt, the federal government spends more money and they add to the deficit, you get a very stimulative effect. For every $1 you add to deficit, maybe GDP goes up, $1.25. But I guess when you cross the threshold of 100% of debt to GDP, then it's not so stimulative. You keep adding debt, you get, the law of diminishing marginal returns. It right. Kind of like slows the economy down rather than quickens it up. What do you think about that?
I think that that's a reasonable way to think about it. The way that it kind of makes sense to my mind is if you have very elevated levels of debt, you need to spend money servicing that debt. And if you're spending money paying interest, I mean, that's not really a productive use of capital, right? You're foregoing investment, you're foregoing R&D. And to me, that's really what causes growth to slow when debt levels rise to levels of 100% or more, relative to GDP. And so, I think looking at that chart in the bottom right-hand corner and coming back to some of the things I said earlier, right? I mean, we need to do something about this. The problem is it's not the easiest thing to deal with in the world. The problem, however, is that if we don't do something about it and we do have an inflation problem and interest rates really begin to rise in an aggressive way, that's going to put not just the US government, but governments around the world in somewhat of a tough spot, because they're going to be spending all of their money servicing that debt, not enough money on more productive resources. And that, Jeff, to your point, will in turn cause the pace of economic growth to subsequently slow.
Right. So if that's why the Fed would be hesitant, because if interest rates go up, the servicing costs right now, they're so low. It's incredible. Right. So if you just doubled the interest rate, the servicing costs would go way up. And isn't that another factor that goes into the velocity of money? If you have to keep using financial resources to service the debt instead of buying things, doesn't that depress velocity of money as well?
Absolutely. It's one can argue that financial assets are not the most productive assets in the world, right? And so there are definitely better uses for capital. And I think that this is all intertwined. And maybe what I'll say to kind of put a bow on it is, I think the last cycle was all about expanding central bank balance sheets. I think that the coming cycle is going to be all about embracing expanding levels of government debt. And what that means longer term is a important and a little bit scary of a question. But I do think that, governments are going to spend more going forward, certainly than they did during the prior cycle. And so we need to be attuned to a lot of these dynamics that we've discussed here today during the call.
Okay, great. Good. Thank you. Evan?
Okay, very interesting. Once again, I recommend the Guide to the Markets, the insights to everybody. It's worth perusing, wandering around inside that document. David, great job. Thank you very much. And thank all the attendees. We'll see you all, in a month?
Yeah.
Thank you.
Okay. All right. Thank you, David.
Thank you.
Yep. Thanks so much, everybody.
Very good. Very good.
Thank you.